Joining us now for more on the latest economic picture following the Fed's latest hawkish messaging, we've got Matthew Luzzetti, who's the Deutsche Bank Securities chief U.S. economist. Excuse me, Matthew. Great to have you here with us this morning. First and foremost, coming off of last week and the decision that was widely expected from the Fed, I guess the big question is, where do we go from here in the Fed's pathway from your perspective?
Sure. First, thanks so much for having me. I think what we got from Chair Powell last week was a decidedly hawkish message. The Fed delivered another 75 basis point rate increase. They signaled we think that another 75 basis point hike is likely in November. We think that they raised the Fed funds rate to 5% early next year. And it really is a central bank that is focused on the incoming inflation data. And I think the message from Powell was that is the number one thing for them. They will risk a recession if that is what is needed in order to get inflation down. Ultimately, we think that is what will be needed and that a recession happens by the middle of next year. But it really, I think from the Fed's perspective, they need to get inflation pressures down. They need to have very clear and convincing evidence that inflation is back on a path down towards their target in order to pivot at some point to a more dovish messaging. But ultimately, we don't think that that's happening this year. We think it's a story for next year once a recession and those dynamics are far clearer.
Matt, we got some commentary or speak, I believe it was on Friday from Jay Powell, saying that we might be heading into a new economic normal. What does that look like in your estimation, and how long might it last?
Sure. So I think we have two things to focus on from the Fed's perspective. It's the near term. How do they deal with high inflation, a very tight labor market, and how do they get inflation back down closer to 2%? That dynamic, we think, ultimately works its way out with a recession, with the Fed tightening very aggressively over the next several months, the economy turning down in the middle of next year, the unemployment rate probably rising to somewhere between 5.5% and 6%. And then I think there's a second question, which is, what does this economy look like structurally after we get past that recession and inflation comes back down? I think we do know a few things. One, inflation is just likely to be structurally higher. Deglobalization and aging population, some of these climate change policies are all likely to be supportive from an inflationary perspective. I think one thing that the economy is also currently dealing with is not enough labor supply. It's a key driver of high wage growth. You see firms that still need to find workers. Job openings are near record high levels. And I think those two things together tell you potential growth in the economy is likely lower going forward, and structural inflation is likely to be higher going forward.
Now, within your modeling for the U.S. economy, how dire does it get in the U.S. housing market? We've seen rates really climb here. It's starting to impact home values, existing home sales, new home sales. How bad could things look?
Yeah, I think what you've seen, given the surge in mortgage rates, the collapse in housing affordability, is that we should still see very negative growth in the housing market over the coming quarters. We think residential investment is almost down 30% annualized in the most recent quarter. But given the leads that we have from housing affordability, that should continue. I think underlying that, there is some interesting dynamics, though. We got housing starts last week, and within that, multifamily housing starts actually hit a cycle high. And so I think what you're seeing is this shift away from single family homes for purchase towards multifamily houses for rent. And it is a signal, I think, that you have a housing market in the U.S. economy that is structurally undersupplied. And so there will be a negative impact near term, given what's happened with mortgage rates and housing affordability. But the longer term story on housing, I think, is actually a positive one from an investment perspective, given that we are structurally undersupplied.
Matt, in previewing this earnings season, in a couple of weeks, we're going to hear from banks, and they're really going to be setting the tone, perhaps, for what consumers, what businesses, small businesses, larger businesses, and even deal making as a whole. We've got a few things that they're going to be able to signal about the state of the economy. What do you expect them to really lay out and to kick off not just earnings season, but kind of the mindset economically right now?
Yeah, I think you have, and we see this in the surveys, whether it's the PMIs last week, the ISMs. It's an economy where I think you still are under supplied in terms of labor. And so firms still have supply constraints, particularly on the employment side. The global supply constraints that we were all worried about before, a lot of those are dissipating. Commodity prices are clearly coming off. But the price pressures now, I think, are coming through wages and the difficulty to find labor. I just think that there's massive amounts of uncertainty about the outlook at this point. How much the Fed will have to tighten policy, the knock-on effects from that to financial conditions, and ultimately the economy. And so I think you should hear from firms that, despite the fact that demand today looks still pretty solid and resilient, the labor market still looks solid and resilient, that the outlook over the next 12 months is highly uncertain. And so that firms, have to begin to think about what do their plans look like if a recession hits over the next 12 months. We still think it happens by the middle of next year, but even the timing of that, I think, is highly uncertain and will be dictated by what happens with near-term inflation data and how aggressive does the Fed have to tighten policy.
We continue to be locked in on all things currency markets, Matt. The U.S. dollar at a 20-year high at just levels not many folks have seen before. What impact will that have on the U.S. economy?
It should help the Fed in many ways. It helps to tighten financial conditions. It makes exports from the U.S. more expensive, so it helps to reduce growth through that channel. Importantly, it should help to bring down inflationary pressures. But most of the goods inflationary pressures we've seen have been on the supply side and supply constraints. So I think it is something that helps the Fed, but I think the Fed needs a lot more help than that. They really need tight financial conditions. They need that through real yields moving to even higher levels. I think they need equity markets to be lower. They need credit spreads to be wider. And I think this is over the past several months, the Fed gave a message at the July FOMC meeting. The market responded by really easing financial conditions. And I think that triggered the Fed's eventual more hawkish response from Chair Powell over the past several months, particularly at Jackson Hole in the most recent meeting. He's really giving no dovish signals at all. And I think that's because the Fed knows that they need tight financial conditions. It'll come through a number of channels. The currency one is certainly one of them. But I think the Fed also needs to see tightening come through equity markets, as we're beginning to see a little bit, but also wider credit spreads.
Matt, we're seeing discretionary names in the equities market right now get a little bit of nibbling action as we kick off today's trading session and this week's trading. Do you believe that within discretionary, there are some more resilient pockets than others that are perhaps not as directly impacted by either inventory or supply chain concerns as others? Because those are things that are definitely out of the Fed's jurisdiction, if you will.
Yeah, I think you have an economy that has multiple phases going on here. We talked about the housing market and some of the collapse in activity that we've seen there. On the good side, outside of autos, you certainly have some inventory pickup issues that have taken place. We haven't seen that show up in the CPI data in terms of price discounts yet, but I anticipate that will come. On the other side, you have the auto sector that still looks supply constrained, very meaningful price pressures, likely have pent-up demand there. And within the services sector, you have an economy that still, I think, is running hot in many ways. You have pent-up demand. You still are below the pre-COVID trend in terms of spending in that sector. You have difficulty finding labor. And so that is, I think, leading to persistent inflationary and wage pressures within the services sector, but also an area where we should see a meaningful pickup in activity. The other thing that I would mention is that gas prices surged earlier this year. I think that was a really important drag on economic activity, particularly through consumer spending. We should not discount how important that is for consumer spending on the other side. As gas prices come down, that helps to lift consumer confidence and should help to lift disposable income in other sectors and ultimately spending in other sectors.
Yeah, I think all those savings over the weekend at the gas pump, Matt, I went out and bought myself a sandwich because why the heck not? Matthew Luzzetti, Deutsche Bank Securities Chief U.S. Economist. Always good to see you. Talk to you soon.
Thanks for having me.